There are a handful of factors that can really drive increased M&A in the year ahead, and first and foremost, we need stock prices to rebound. 2023 was a very difficult year for bank stock, and we saw decreased valuations across the industry. This isn't the only factor that slowed M&A in 2023, but it was a real driving factor as bank stocks weren't as attractive to execute a deal. As noted in the 2024 Bank M&A survey, the majority of buyers didn't think that their stock was in a position where it was attractive enough to have a successful deal. And we need that to change if we're going to have M&A return to the historical levels that we've seen. Secondarily, we need interest rates to either remain where they are or fall slightly. The current interest rate situation that we're in is providing an environment where there's a lot of excess goodwill created from transactions. We have lots of AOCI on the books still, and loan portfolios are coming in at valuations that are well below par. This is due to the assets on the books being brought on with very low interest rates compared to the swift increase we have seen in rates in the past 18 months. Now that's going to correct itself over the coming months as those portfolios start to roll over. But if we really want to see M&A jump started in 2024, we'll need to see those rates pull back a little bit so that we can have valuations that make sense for the deal metrics. There are a few key attributes potential buyers are looking for when it comes to a potential sale target's deposit base. Primarily, they're looking for stability. Buyers need to know through their diligence that these deposits are going to remain there for years to come. Given the liquidity concerns in the marketplace, the 2024 Bank M&A survey results showed that a stable and strong deposit base was a very appealing and motivating factor for conducting a transaction in 2023 and into 24. And that's not going to change given the current state of liquidity in the industry. Buyers need to be confident that they're going to be able to realize that value through the stable deposit base. What fuels this? We need to understand the current interest rates that are being offered by banks to their depositors, as well as the fee structures associated with those accounts. If there's a big mismatch between what those rates are and what the fees are and what the buyer is offering their customers, there's going to be an increased risk of attrition in the coming years as those customers may leave to find a bank that offers what they're used to with the prior seller. The second factor is understanding the composition of those deposits. Do we have deposits locked up with a few key customers who have large balances? Do we have a lot of CDs that are shorter duration, which we've seen an increase in those 6 and 12-month CDs over the past year, given the rate environment? And then do we have a strong mix of interest-bearing, non-interest-bearing savings accounts that we can have confidence will be there for years to come? There's one primary obstacle that, if it comes to fruition, will be a gigantic headwind for M&A in 2024, and that's the potential for credit losses to finally manifest in the environment. We've been talking about credit risk for the past decade or more, and we just haven't really seen those losses come to fruition. However, there is a lot of concern in the industry over potential credit risk in commercial real estate and consumer credit. And it's all tied together. And so if you start to see losses on one side, it's going to bleed over into the others. We see this in the Q3 ACL reserve increases that were published in the recent call reports, where banks are increasing their reserves to account for some of that risk. And so if we actually do start to see those charge-offs being realized, it will be an absolute detriment to potential M&A, as buyers aren't willing to take risks when there's credit losses manifesting. There's liquidity and capital concerns, and then there's overall concern over the quality of the institutions that they could potentially be buying, because there's only so much comfort you can get from credit diligence. You can't look at every single loan, and when there's risk and uncertainty, it just is a detriment to that M&A. The primary thing bank leaders need to understand about goodwill's impact on deal prices is generally more goodwill is not a good thing. That excess goodwill typically deflates the value that's seen from a transaction, and it also presents a situation where that value realization from the buyer is more difficult to obtain. On a basic level, tangible book value per share decreases the more goodwill there is due to the accounting construct of it. But overall, that realization from the seller's perspective becomes much more difficult when there is excess goodwill. One of the interesting things that I'm seeing in the market today is something we've seen historically in the Bank M&A survey. There's a disconnect between the price that buyers are willing to pay for a bank and the price that sellers are willing to accept from a transaction. And we do see that moving up and down over the years, but we're definitely in a situation, given the current environment, where it's on the lower end of the scale, especially from recent transactions in Q3 and Q4 of 2023. And what's interesting is that seems to be led from the buyer's perspective, and sellers are starting to kind of realize what the price is and accepting that for the transactions. And that's creating a situation where we are starting to see transactions occurring, but we do have this goodwill conversation that's on the table. And one of the interesting things about it is after a transaction, excess goodwill tends to have a negative impact on the buyer's stock price. And a lower goodwill tends to also have a positive reaction on the buyer's stock price. And so when you're thinking about what that ultimate price is going to be, you can't just focus on the deal announcement and what those terms will be. It's important as the seller to look forward so that you can realize that value creation that you're looking for in the transaction and think through what that movement will be and the impact on the total consideration. I do think we will see increased bank failures in 2024, but not in the levels that we saw in the prior recession. I think there's going to be some winners and some losers in this situation, and there will be a handful of banks that fail. And similar to the results of the 2024 Bank M&A survey, the industry isn't expecting there to be a significant number of failures. But in any interest rate environment like we have today, where you have lots of AOCI, you have portfolios that you need to unwind, some banks just won't have the capital or the capability to unwind those portfolios successfully, and you will have some failures. I think in any instance where you have bank failures, there tend to be a handful of organizations who are poised and ready to capitalize on that to execute a failed bank transaction. The thing about it is the buyers need to have sufficient capital and sufficient cushion to execute, as well as they need the talent on hand to understand how to capitalize on that to get the value realization that they're looking for from the transaction.